Okay, the hangout is live. I'm gonna send the link. Okay. Satya, you have a WhatsApp installed on your laptop. There's a link that I want you to send to Mohali group. How will you send it from here to? Okay, copy the link. Mail पे भेज दो एक बारी पाविका को. Pavika will put it on the group.
हाँ ठीक है.
Okay, the link is already in the copy pasted thing.
ठीक है.
Not this one. Don't open.
लिंक आपने कॉपी कर दिया था.
मेल पे भेज दो एक बारी. ये कहाँ से चल रहा है? Okay, the link is already in the copy pasted thing. ये तो मेरा ही खुल गया. चलो I send it. Not this one. Then open the link.
लिंक आपने कॉपी कर दिया था.
मेल पे भेज दो एक बारी. Pavika will put it on the group. Okay, the link is already in the copy pasted thing. चलो I send it. Not this one. Then open the link.
लिंक आपने कॉपी कर दिया था.
मेल पे भेज दो एक बारी.
I'm buying this and I'll sell it outside to any finance. Taxes की बात की तो IRR entry की claim some somebody बोलेगा और फिर हम
तो IRR सर जैसे ही पावर फ्री होगी ना डिनोमिनेटर केसी इसे वो भाई बोलो यही है अगर 20 साल का हो गया IRR किलो हो गया 4 साल
सेक्शन
वो एंड्रॉइड में बच्चा पढ़ो ना तो ये साइकिल पढ़ो
नहीं मैं
भाई अपना ध्यान
यार
भाई ना ध्यान रखना
कौन भाई
5 मिनट पहले यार मैं तो बुला के लेके जाऊंगा ठीक है सर कोई नहीं कहता जो 2 दिन तक नहीं लगेगा तो नहीं खा लेंगे
भाई सुन लो यार वो माइक पे फोन
ये वाली बहुत ये हो जाएगा लाइट ऑन कर
Praying on the prayers of your classmates.
You guys, shall we start?
Let's drop mic.
Okay. So first, let me run you all through some very basic concepts of present value, future value, annuities, annuity due, NPV, perpetuities, and APR and effective interest rate. Then we'll have a look at the financial calculator. I'll be doing a demo on the Texas BA2 Plus. Anyone has any other type of calculator, I can do it after the session. Okay. So present value. Basically, the first step towards any problem is to draw a timeline where you list the number of years and then you have a bunch of cash flows which we apply a discount factor to. Okay. Now, Weber, why do we discount the cash flows? Okay, tell me, why is $100 more valuable to you today than receiving it 5 years from now?
$100 invested somewhere and then.
Okay, that's one reason.
Yeah.
Second,
Inflation
okay,
value of $100, what I'm getting right now. So let's say a calculator, I get it for $100 today. Tomorrow, 10% inflation, it will be for 100.
done. And third reason is that I may not pay you $100 in 3 years, 2 years time. So to incorporate inflation, opportunity cost of capital, and the risk of not getting it, all of that is incorporated in a discount rate. It can be 8%, 10%, whichever rate. All right. So whenever we get cash flows, if you want to equate it and find the present value, basically we are pulling all of these cash flows to the present value, that is today. So we get the first year's cash flow of $100. Today it will be worth 100 by 1 plus 10%. All right, or 1.1. The cash flow got in year 2 would be worth 100 by 1.1 square. Cash flow in year 3 will be worth today 1.1 cube and so on, 120, sorry. And this will be 150 by 1.1 raised power 4. So the present value will be the sum of all of these. All right. Now, how do we get the future value of these cash flows? Anyone? Ajit? What is the future value of 150 at year 4?
Year 1 would be 150.
Okay. What about 120?
It will be 120 into 1.1.
Yeah. So basically, instead of receiving it at time t, when you're receiving it at time t plus 1, you have to multiply it by the discount rate. All right. And 100 similarly will be 1.1 square. And the year 1 cash flow will be 1.1 cube. So this is a basic concept of present and future value. Cash flows at any point in the timeline can be pushed towards year 0 or the terminal year, and these are the conversion factors for the cash flow. This is the most basic thing. So any problem that you get, first construct the timeline, place the cash flows wherever they are according to the timeline, and pull it to the present value or the future value. Okay. Everyone clear on this concept? Okay. Then next, let me go to the concept of. Sorry.
1 second.
This is there in the notes. Swami.
I don't know.
Right,
Just 1 second.
Okay, sure. Again, the first step to any problem is constructing the timeline. Annuity is nothing but a stream of cash flows in which all the cash flows are the same. So if I get 160 everywhere, this is an annuity stream. It can be any cash flow as long as the cash flow is the same in year 1, year 5, year n. All right. That is the basic concept of annuity. And the concept of annuity due is instead of at the end of the period, you will receive it at the start of the period. There will be no cash flow over here. So if you are a borrower, would you prefer an annuity or an annuity due, Ashish? You're taking a loan.
160 तेरे को मिलेगा.
Depending on the discount rate. Go ahead.
The annuity due is the second one, right?
Yeah, this is annuity due and this is annuity.
Annuity.
Yeah, annuity is when it occurs at the end of each time period. Annuity due is when it occurs at the start of each time period.
Right. So I'm saying if I'm a borrower, I would prefer annuity.
Okay, I have a question here. Just if you don't mind. कि when would you prefer your money? At the beginning of the year or end of the year? अगर तुम्हें मिल रहा है पैसा.
Beginning of the year.
तो फिर?
Annuity due.
All right, and lender it would be an annuity because you would receive payments for that extra period. So any formula that you have converting from annuity to annuity due, whatever answer you get, you can first equate it as an annuity as we are used to these kind of cash flows and just multiply this by 1 plus R. Whether it's the present value of an annuity or future value of an annuity. Because as you can see, all of these cash flows are pulled one period to the left. That is, they're discounted for one period less. So conversion of present value annuity to present value annuity due, just multiply that answer by 1 plus R.
So the conversion the other way around, you divide it by 1 plus R.
Yeah. From annuity due to annuity. But most problems, students are most comfortable with an annuity based rate. And regarding the complicated annuity formulas or slightly complicated, you have C by R into 1 minus 1 by 1 plus R per n. I'll show it on the calculator. It's much easier, and on the Excel if you guys want it, because in real life nobody remembers these formulas, present value, interest factor, and all that. So just learn it on the calculator, and you're good. Okay, then perpetuity is nothing but a stream of cash flows that occurs forever. All right, and if the stream of cash flows is say C, that goes on till infinity. Now there's a slight mathematical derivation, but for our intent and purposes, you can learn up this formula. It's nice and easy. And if the present value of
a little bigger, sorry, I can't
Yeah.
see what you did.
Okay. All right. So this is the present value of a perpetuity stream. A growing perpetuity stream is something that increases by a constant rate every year. So if it starts off with 100, then say 10%, it would be 110, 121, 132, where my math ends. So this is a growing perpetuity. The formula for this is C by R minus G, where R is the discount rate, which encapsulates inflation, opportunity cost of capital, and risk of not receiving it. All of these three are incorporated in this rate. And G is the rate at which the perpetuity grows.
G greater than R.
Yeah, G has to be greater than R.
Less than.
Sorry, less than R.
If it is, if G is greater than R, it is G minus R, right? So you just take mod of
Right. So the thing is, just imagine that something is growing more than the discount rate. Okay, so every year you're ending up getting more and more, and it is surpassing the discount. Won't it be equal to infinity?
You'll have infinite.
You'll have infinite money. It's like you're getting every year some amount of money, which is more than the inflation rate. Your life is set. Okay, so that's the reason that this formula is not able to give you infinity. It will give you a negative thing, but that's not possible. So actually, this means that you'll get infinity.
But in actual effect, I don't think there are any cash flows that can grow
Faster than this.
faster than the cost of capital and grow infinitely. This is a very hypothetical concept. Okay, so everyone clear with present value, future value, annuities, annuity due, perpetuities, and growing perpetuities. All right. Then coming to the concepts of annual percentage rate and effective annual rate. All right. Lots of times banks might quote say 12% APR compounded monthly. Right? What do you guys understand by that? Anyone? How do I convert this to effective?
1%.
1% monthly.
Yeah, so but there's a formula for that, no? For that. Converting APR to EAR. Sorry. 1 plus EAR equals?
No, AR equals to 1 plus APR by K.
To the power K. So you have EAR. Right? Where K is the number of compounding periods. If I say it's compounded monthly, K will be equal to 12. If it's compounded quarterly, K will be equal to 4. If it's compounded daily, K will be equal to 365. So in actual effect, most of us take out loans and pay EMIs, it's compounded monthly. So when a bank quotes a rate, you will first have to transform the APR, that is the quoted rate, into what you're actually paying. So the formula is 1 plus APR divided by 12, since you're paying it in monthly installments, raised to the power of 12 minus 1. This is the conversion from annual percentage rate to effective annual rate. So why do banks and other organizations usually quote an APR?
उल्लू बनाने के लिए. So actually, I this is how I learned during my time what is APR and difference between years. So that don't forget, APR is the ullu rate. Okay. So whenever you see a APR, so that is not the real rate. It means you have to calculate the real rate. And if there are, let's say, quarterly payments, then you know that the APR 4 बारी देना पड़ेगा. So divide by 4 करो. So it's just saying 3% per quarter or 1% per month. So this is how you can remember. This is how I used to remember it. कि APR यानी कि उल्लू बना रहा है, उसको पहले सही करो और फिर उसका ईयरली रेट या फिर जो भी आपका पेमेंट जितनी भी देर में कर रहे हो कैलकुलेट करो.
When I'm explaining the demo of the financial calculator, we'll calculate the EAR to the APR. So as Mudit said, usually the APR is almost always less than the EAR because APR is quoted as compounding once per year. So when you're paying daily or weekly or monthly or quarterly, the EAR will always be greater than the APR. So to the layman, we think that we are paying a certain rate, but in actual effect, we are paying far more than that.
Actually, a question, Mike, here. I don't understand logic of calculating EAR at all. I mean, for the payments, whatever we want to calculate, we can just divide APR by that thing and then take the cash flow for that particular period and calculate it. Why do we need to calculate EAR apart from if they've asked us a question ki EAR calculate karke do?
Because as a borrower, you would want to know what is your effective rate that you're paying. Like you said, a banker or somebody, relationship manager quotes you a rate. You want to know what you're actually paying.
So it's just for the information. There is no use. I mean, I can do all the calculations based on APR. In fact, I have to do all my calculations.
You can, but say I'm taking a loan of many lakhs or crores. I would 0.5% would make a huge difference. So as a layman, I would think that I'm getting it at 12%, and I would not know where my money is going. All right. Okay, so next I will move on to the use of a financial calculator. Everyone get your Texas calculators out. Whoever's got that.
I was only given a Casio by somebody.
Okay, others? Okay, then just share it with your neighbor. Ready now? Perfect.
Which one do you have?
Texas DA2.
Captain P1. Only Romani who voted.
Hey, everyone has a calculator or is sitting next to someone with a calculator.
Wait, can I download? 1 second.
And in your opinion, how important is it to buy this extremely expensive calculator for multiple exams?
You can do with the cash flow tables also. I mean, this is something that I've fought with professor for him to provide to you during the exams. And I think the kind of work that is given in the assignments, quite possible with the cash flow tables also, right? If you don't have the
It's possible, but if you take up any corporate finance elective or any finance elective, then you would definitely need a financial calculator, and you can use it for life, no? If you need it for any, unless you marketing.
That it has spent money on this stupid Casio deck.
Casio is fine as well. Sorry.
Right, for all other things you can use the exam.
I mean, you'll finish your exam a lot late. You'll finish your exam a lot late with a scientific calculator, and there will be many, you know, ways that you can commit an error just by missing a bracket or something like that. So that way, financial calculator is going to help you. But if still you don't want to buy it, I think financial tables are enough for you to actually calculate everything.
See, the advantages of a financial calculator is that you don't have to remember any formula.
Yeah.
From your present value, future value, payment, amortization, everything can be done with a financial calculator.
Just would like to add something to this, that financial calculator does nothing but just a calculation for you. If you don't know what the concepts are, financial calculator is of no use. So calculator is just a tool. Understand the concept, you can do it in any calculator possible. It might take a little longer, but you can do it.
But for someone from a non-finance background, Saurav, it will take really long. 2-3 minutes question will take 10 to 12 minutes.
That is true.
Understand the concept or not.
Can you tell them the financial table of factor? Yeah, that is too easy. How to convert annuity into present value or present value to annuity. You just need to multiply with
I'll just go through this.
This is not clickable. This is just a picture that I put so that you can tell ये वाला button दबाओ.
Okay, guys, Swani, you want to sit next to someone with the calculator?
I got one.
Income tax also for that package.
Okay, next is CFA.
When I buy, I buy that one.
No, because I'm showing you the demo. Something else you want.
Just check this slide. Is it very different from what you're going to use? Yeah.
Okay, anyway, try saying that. Okay, guys, I'm going to start the basic calculation to find the net present value of a cash flow stream. So first thing that you guys want to do is press second cash flow. You will get CF0, and then second CEC. So that clears everything. That clears whatever cash flows that were entered before. All right. Everyone clear it? Then second thing you want to clear is click on second and clear TVM, time value of money. So this clears the memory of the calculator.
1 second, Mike, repeat, please.
Wait.
So that you know what they are pressing. Otherwise, it's very easy to get it wrong.
क्या?
ठीक है.
इस पे दिखाने से अच्छा है साथ में बैठ के करवा दो.
So Saurabh, what I suggest is let me show it here and you divide it in groups and check for your local groups.
चलो यार एक बारी कैलकुलेटर देख लो यहाँ पर यूं आ जाओ एक बारी सेकंड दबा के CEC दबा देना सारा कुछ क्लियर हो जाएगा फिर सेकंड दबा के FV दबा देना अब सब कुछ क्लियर हो गया फिर क्वेश्चन शुरू करना हर क्वेश्चन से पहले रिचुअल बना लो कि सेकंड दबा के सारी मेमोरी क्लियर
Second cash flow clear and second clear TVM.
Okay.
Before the start of every question, please do this. Otherwise, whatever values that you all have entered will come into this question and you all will get the wrong answer.
What was the second thing you said?
Cash flow and
Second, clear time value, TVM. Okay, now let's enter a cash flow stream. Suppose I want to find the present value. Everyone can see this. Okay, I have an initial outflow of minus 600 and then these are my cash flows.
You can take this.
Second cash flow.
Second.
Okay.
ठीक है कोई चक्कर
And direct estimate.
So don't worry, it will come, the right answer will come. I can assure you that.
We can't see the value.
Alright guys, everyone, let's practice this. Initial outflow of $600 and then you have 5 years of cash inflows, 100, 200, 400, 100 and 200. So let's start off. Click on cash flow, enter 600 and then enter this plus minus button. Everyone with me? So it becomes CF naught minus 600 and in order to enter this value you need to click on the enter and down arrow string. You click on cash flow, then 600 plus minus and then enter and down arrow. Yeah.
Down का मतलब अगला.
Whenever you have to enter any value in a financial calculator, always click on enter and then down arrow. That shows that you enter the value and then moving on to the next set of values to be entered. Then all of you all see a C01. Okay, next enter the next cash flow, 100. Again, same enter and down arrow. If it is negative, then you make it negative. Yeah. Yeah. Exactly. 600 plus minus and then enter it.
ये calculator मैंने इसमें लिया था.
If it is minus 600 and you basically it just changes the sign. If it's minus 600 and then you click that button, it becomes plus 600. You don't have to because plus 100 is the same as 100. Then F01, you enter 1.
Enter down.
Yeah. Enter, press 1, enter down. F01 is basically the frequency of the cash flow of $100 occurs only once. So you enter it 1. Now the similar way, let's enter the next set of cash flows, 200, enter down, frequency 1, enter down, and then 400, 100 and 200.
CF0 के बाद वो फ्रीक्वेंसी नहीं पूछेगा. CF0 एक ही होता है. CF1 के बाद वो फ्रीक्वेंसी पूछेगा. CF2 के बाद वो फ्रीक्वेंसी पूछेगा. मान लो आपका ये होता है -600, 100, 100, 200. तो क्या करते हैं कैश फ्लो 1 में हम डाल देते हैं 100 फ्रीक्वेंसी 2. ठीक है ना? तो 2 साल के 100 ले लेगा. फिर CF2 जब आएगा तो वो
Okay guys, after entering all the cash flows, click on the NPV button. It will ask you for I.
Yes.
I, you all have to enter 10%. Enter in terms of percentage terms in the calculator. So if it's say 17%, you all don't enter 0.17, you all enter 17. If it's 23.3%, you all enter 23.3, not 0.233. Alright, enter down arrow, you will get NPV and click on compute.
Now you see it. You can cross check everything. 149.2.
149.2.
149.6.
Second cash flow.
Clear again.
Second forward timeline. But you have
Everyone gets 149.21. Yeah, always enter 1. Enter down. Yeah. Say enter cash flow 6. You see 06 to enter it. Frequency F06 enter 1 and then click on any.
It says error 4.
Okay, guys, everyone got 149. Can we move on?
Tell me, I'll speak.
No, because just I know this exercise we can split it up as who uses it into small groups of 10.
Yeah.
Like I think you suppose this other column. Cash flow 600. Cash flow 1. Cash flow 1. Okay, just 5 more minutes. So guys, next let me move on to the frequency tab. Suppose you'll have a stream of cash flows where there is initial outflow minus 600 followed by 4 years of payment of $100 and 5th year of 400. Over here, what you do is CF0 you enter minus 600, C01 you enter 100, frequency you enter as 4. That is for 4 consecutive years you get 100. Then next when you enter C02, it is actually cash flow in year 5 because C01 has occurred with a frequency of 4 times. So once you enter C02 400, F01 as 1, NPV, IRR you. Yeah, I'll go to IRR. So NPV, this are you familiar with? Everyone got this answer? Just try this once a minute. This trick using frequency. Always remember to clear the calculation. Yeah, I clear. Okay, just leave this for the time. I'll come. I'll just 10%. You should get minus 34.7. Minus 34.6. Okay, guys, next I'm going to show you how to compute the annuity amortization table payment on a financial calculator.
Yes. So future value is the same calculation.
Future value? Yeah, I'll show it to you right now. Everyone, can I move on?
Yeah.
Okay. So basically, this gives you the number of periods. 1 by Y gives you the interest rate, present value function, the fixed payment function like an EMI, and future value function. So if you want to compute any of these, you must be given data for 4 of these variables. And 4 of these variables, all you need to do is enter the value, click on this button, enter and down arrow. Remember that if you have to enter any value into this calculator, it's always enter and down arrow. So you enter 4 values out of 5 and then compute the 5th value. Alright, can we solve a small example for this?
Then those 4 values have to be in a specific order or.
No, it can be in any order.
But how will it understand what is the rate? What is this?
That will because the rate you will be entering into this button, right?
You can do an example.
Sorry, you press the button and then enter the value.
Okay. Okay.
Minus 34 something. Hey, everyone try and solve this problem. Let's find the number of periods.
So what is happening is this value is 1000.
Saurabh, can we get their attention here? Okay. Sujit, we'll get back to that now. Okay, guys. So I've given you all 4 of the values out of these 5 buttons, and I'm asking you all to compute n. So you'll start off with entering what is there. Enter 1000. Click on PV. Enter and down arrow. Enter 1330. Click on FV. Enter down arrow. Enter 8. Click on 1 by Y. Enter down arrow. Enter 0. Click on PMT. Enter down arrow and then compute n. All of you all do that and tell me the answer.
My question is, what is happening?
You also get 3.6.
I'll buy it. I'll take his amount.
No, compute n.
He's just roving around. No, you have to get this. Buy it.
Yeah. Another important thing is when you all are entering the future value, please enter as negative in the calculator. You must have entered future value as positive. Yeah, I'll tell you why negative. Suppose you are investing something that is a cash outflow. If by convention you use that as positive, then any cash inflow will be negative. If by convention you use investment outflow as negative, then inflow will be positive. So PV, PMT and FV, you all have to clearly distinguish what is the outflow, what is inflow. Plus minus is completely arbitrary. If you all have all inflows as positive, then all outflows will be negative. If all inflows are negative, then outflows will be positive. Unless you all enter the correct sign convention, it will show an error in the calculator. If you enter PV minus 1000, then enter FV plus.
Akshita, do we enter 8 as 0.08 or 8?
So just check. I don't know 3.7. Sorry. 161. I just say.
Compute and then end. Right?
Yeah.
Once I've entered all. This is compute.
Yeah.
Okay, I don't know now. What the fuck is this? I'm not using it.
So, everyone got this one yet or not?
No,
No? Who said no?
I said
आपके पास कैलकुलेटर है?
And okay, this calculator.
ले गया कोई बात नहीं I'll see on this.
इसमें है?
Yes.
Okay, and lastly, yeah, so just second thing. Sort of, I'll just finish one last concept on the calculator. Guys, one last concept on the calculator, compute the IRR given a stream of cash flows. Yeah, try and compute the IRR using the calculator. N is 3.7. Again, guys, click on cash flow, second and clear. You clear the memory, right? Then first cash flow 600. Click on the plus minus button. This problem. I want the IRR for this.
Once you enter all the cash flows, you just click on IRR and compute, right?
Compute IRR.
Compute IRR.
So
Yeah.
enter cash flow and then compute IRR.
Yeah. Just try concept. Frequency is 1, and remember that to enter any value, you have to click enter and down arrow. You all will get 25.7%.
Discount rate is 10%.
Sorry? No, you don't have to impress I for the IRS. I'll show you. No, I know. 25.7%. Everyone got? Yes.
IRR
It was 500.
After simply press IRR. I don't know. I that test.
Yeah, everyone got 25.66%. No, one second. Sorry. Cash flow. And second. All done? That is the effective interest rate, 8% per annum compounded yearly. The entire session, yeah. Sorry. Yeah, that. For present value, I need to give you a discount rate. I need to give you a discount rate for that.
So give us a discount rate.
8%. Hey guys, I'm moving on from the financial calculator. Does anybody want to know amortization function on the calculator?
Yes.
Data.
Like in this, what is in vehicle with IRR, what is happening in that is we are paying 600 now,
So do you have an
And then we are getting these amounts later.
Yeah, exactly.
There's one where you take a lot of time to solve the questions without using an app.
This one, I would be basically. So this one.
Okay, guys, I'm moving on to the concepts.
When I get
What do you all understand exactly by IRR? You all calculated the IRR. Anybody wants to explain what exactly do you all understand by IRR?
Is that rate of return which you net as value of your cash flow?
Is equal to 0. So we need to find out what rate of return, let's call it R, will equate the present value of the outflows and the inflows. Basically, the net present value is nothing but PV of inflows minus PV of outflows. So you have minus 700 plus 200 by 1 plus R, right? This is the NPV. Plus 450 by 1 plus R square plus 900 by 1 plus R cube. IRR is basically what is this rate that makes the NPV of the project equal to 0. Or put it another way, the PV of the inflows should be equal to the PV of the outflows. So in real life, you all might open up a plant or an investment venture where there is a fixed capital outlay, followed by periods of cash inflows. So you all know how much you all expended, and then what is the amount that you get in the project each year. When someone says, what is your IRR, you need to find what the discount rate is that equates the NPV to 0 or the PV of the inflows, that's 700, to the PV of the outflows. That's all that is to IRR. Now there are a few problems with IRR. In case I have a cash flow stream where initially it's negative followed by positive cash flow, there's no problem. But if I have a terminal year cash flow negative, then to solve this quadratic, you will get no unique, you won't get a unique solution. It's quite complicated to solve this, so just take my word for it that you will not get a unique answer for IRR. So that is the known as the problem with multiple IRRs. So whenever you have a non-conventional cash flow stream, a conventional cash flow stream is initially negative followed by positive inflows. This is a non-conventional cash flow stream. Then you always use the NPV criteria. NPV criteria always trumps the IRR. IRR gives you in percentage terms what is your return from the project. NPV gives you an absolute amount. So usually in mutually exclusive projects where if you have say A and B, NPV and IRR, say 230, 190. And this is 12% and this is 8%. Which project will we invest in? Why so? Exactly. Even though the IRR is lesser, we take the absolute value given that A and B are mutually exclusive projects. And all of these can be computed in Excel as well. Right?
So IRR is the discount rate.
This discount
For which NPV will be 0.
exactly.
Now what that means is that in a business scenario, when I get to know an IRR, what do I use it for? Here it says 8 and 12%, right? So if for project B, my cost of capital is more than 12% and my IRR is only 12%, that means that I should not take that project, right? Because my project is giving me only 12%, my cost of capital is more than 12%, don't take the project. That is what the IRR, use of IRR is. Now, go.
Yeah, if IRR is greater than the cost of capital, accept the project. Suppose from a bank you're borrowing money, say State Bank of India at say 10%, and your project IRR is 7%. It makes no sense for you to borrow at 10% and then get a project even with a positive NPV and positive IRR, but it is less than the cost of capital. So in order to accept a project, the IRR must be greater than the cost of capital. For equity, it's usually 15 to 20%. Debt, it can be 8 to 12%. Depending on the borrower, it can go up or down, depending on that.
Greater than IRR, then you have negative NPV.
Yeah, so you don't accept the project. I'm not talking about scenarios where the NPV and IRR are in conflict, but generally, what is the criteria to accept a project based on NPV and based on IRR? All right. See, NPV gives you an absolute measure of returns, a dollar amount. IRR gives you a percentage amount. They're in a sense similar measures, but there are subtle differences. Like IRR can have multiple, in an unconventional cash flow. Then between mutually and exclusive projects, you might think B is better because it's giving you a greater return, but in absolute numbers, A is greater. All right. If we plot the graph of an NPV function with cost of capital, as cost of capital increases, the NPV will keep decreasing. So we need to find that value of the cost of capital for which the NPV is equal to 0. And like somebody mentioned, if it goes beyond that, the cost of capital, NPV will become negative. Yeah.
While choosing between the two projects, first thing I see that IRR is better than cost of capital or not.
Right.
And then I see that which project is getting higher.
Right.
Generally, an IRR is kind of a criteria that how much cushion do you have. NPV is the decision criteria. So 230, 190, generally you will go with 230. What that IRR tells you is that, okay, your current cost of capital is, let's say, 6%. So one project you have at 8% IRR, one project you have 12% IRR. So in the project with 12% IRR, you have more cushion. That even if your cost of capital increase from 6 to 8 or 8 to 10 or 10 to even 12, you will still be okay and not going negative. So it gives you that region or the cushion in cost of capital in which you are still safe and not going negative. The decision making criteria is generally only NPV.
Cost of capital is interest rate.
Discount rate. Discount rate.
Interest rate together, bank charges.
Multiple things goes into calculating a discount rate. One of it is cost of capital. We talked about 3 factors to calculate the discount factor, right? Risk, actual cost of capital, and what was
Inflation.
Inflation. So all those 3 things play a big part when it
Project
comes
A
to
cost of
discounting.
capital is 12%, project B cost of capital is 10%. Then which one will be selected?
You would reject project A because IRR is less than 12%. Now, for project B, it's a judgment call. Usually, you would reject it, but if an NPV will not be 190. Okay.
One question. When you look at NPV per year, when you have
Equated annuities approach.
Yeah.
I'll get to that.
If the cost of capital is suppose 5%, I mean less than 8%, then in that case we will look at the NPV to judge.
So
We will always look for NPV.
I mean, if the cost of capital is less than the IRR, for example, if cost of capital is suppose 5%.
yeah, IRR is greater than cost of capital, you accept the project.
So in that case, out of these 2 projects, we will select the one with the higher NPV.
Correct.
So IRR is the elimination criteria, right?
Okay, guys, can someone quickly tell me the NPV of these 2 projects at a discount rate of 10%? The professors do it. Someone financial calculator practice, just tell me the NPV of these 2 projects.
If NPV is greater than 0, so can we say that always IRR will be greater than cost of capital?
Correct. Yeah, that's right. So the NPV is equal, IRR is that discount rate which makes NPV equal to 0. If IRR is greater than 0, NPV will be greater than 0. If IRR is less than 0, NPV less than the cost of capital, NPV will be less than 0. What is the NPV?
178.46.
And
You want the IRR also?
No, just NP. You know this one?
no, this
Minus 61.4.
minus.
Mine, we can't read all the figures.
Which one are you looking at? The first one is minus 1,000. Maybe you can make a note.
Everyone got these two answers?
Yeah.
Everyone.
1.1.
Anyone having problems with the calculator? Minus 400, 100, 300. Oh, so actually, okay, whichever. As long as you have got the ballpoint figure, right? So depends on the plus minus. Okay, so then one change is 2 IRR, two changes is 3 IRR. Okay. Minus and the number of changes equals okay, guys, moving on. Next one, Kartika. Okay, payback period. You have a project which has an initial cash outflow of $1,000 followed by 4 years of inflows, $400, $300, $300, and $500 successively. Payback period is a measure of when you will get your money back. Most projects that we look at in the layman terms, we look at it in terms of payback period. So the payback period over here is how much? How many years? 3 years, right? It is when the cumulative inflows is equal to the initial outflow.
No discounting, no time value of money.
Most laymen don't do that. So it is a rough measure of when you will get your money back.
But there is a formula for this, right? A plus B by F, some formula with which you get exactly the payback.
It's a simple average thing basically. You
The
get
exact
back the cash
payment period for this Ryan is 3.00 years. I can, but when you get it in between that, what happens is, suppose this is say, I'm getting to that. First, let me just explain the concept, then I'll come to the formula. Say it is 250, right? So the sum of the cash flows of the first 3 years is 950. Everyone with me?
Yeah.
Vinayak? 950. Then how do we go on to the payback period for this stream of cash flows?
500 divided by 12.
Okay, the initial outflow is 1000. Up to year 3, we have got 950, right? Now the interval between year 3 and 4 is 500. The difference between 1000 and 950 is 50. So it will be 1000 minus 950 divided by this interval, right? Which you will get it as.
You don't have to reduce minus 250 directly find.
Sorry.
It's basically a law of averages, simple. 3 years में मेरा 950 हो गया. Last year I have got 50. I'm going to get 500. So in 1/10 of the year, I will get that 50 back. So the answer is 3.1 years.
But like 500 you are supposed to get at the end of the year, right?
Yeah. So you
will also will get at the end of the year.
You think of it as an average throughout the year. Payback period is like no time value of money concept. Payback period is a simple maths concept, let's say.
And just to give you all a little bit more of practice, suppose this was 200 and this was 600. The cash flow up to year 3, the cumulative inflows is 900, right? So the payback period will be 3 years plus 100 by 600, which will be about 3.17 years. Everyone got this concept? The difference in amount to make up for the inflow, that's 1000 minus 900 divided by the cash flow that's occurring at that year. This is simple extrapolation.
And why you do calculate payback period is that ignoring all the time value of money concept to get a very generic idea that how many years is it going to take for me to get that money back.
It's a very high level, if you just want to look at a project snapshot within 2 minutes, what's the project all about? What is the outflow? What is the interest rate? In how many years or months we'll get a payback? So it's a very, high level overview. Then we come back to the discounted payback period. Discounted payback period, as somebody said, you discount each of the cash flows to the present value. Each of these cash flows are discounted to a present value factor, and then when the cumulative inflows is equal to the cash outflow will be your discounted payback period. All right. So say a discount rate of 12%. Someone can tell me what is the present value of this? 393. Present value of year 2 cash flow? 311. Year 3?
452.
So we'll have to go into year 4 as well. No, I think this should be sufficient. But anyway, tell me, year 4?
254.
There is one quick question. Payback period is 3.1 years. My discounted payback period, is it going to be more than 3.1?
Or less?
No.
More or less? Anybody thinks less? So if payback period is 3.1 years, my discounted payback period, is it going to be more than 3.1 years or less than 3.1 years?
Why will it be less than 3.1 years?
The thought is this. Even when you did not discount the cash flows for future years, you got the payback period 3. Now, if you're going to discount it, you will take more time to realize that money, right?
Sorry?
More than 3 years. Because now you are discounting, the value of the future cash flow has gone down, so you will take more time to recover the initial outflow. Confused question or clear?
Like, if you need to see the 1,000 which you are getting initially, so the present value of will be less than 1,000.
Sagarika. So these are the cumulative cash flows without discounting. 440, 440 plus 390, 440 plus 390 plus 610. These are the discounted cash flows, and this is the summation of the discounted cash flows. 393, 393 plus 311, 393 plus 311 plus 434. All right. So as you can see, the payback period without discounting will always be less than with discounting, because the cash flows that are being pulled to the present value will be lesser, because we are applying the discount factor. So anyone want try and calculate, guys, what will be the payback period for this? I want to know the payback period and the discounted payback period.
So he has given you cumulative cash flows, cumulative discounted cash flows. So can you calculate the payback period?
For those of you at the back having trouble reading it, please shift forward.
Normal one is 2.27.
2.28.
Like that will be 830. 830. 4 after 440 will be 830.
Okay.
And 440 will be 1440.
This is 2.28 years, and what about this one?
2.68.
Yeah.
1100 to cumulative for the third year.
Guys, this is very likely to come in the midterm exam, since he's touched upon this. So make sure you all get these answers. Anyone having any doubt with any of these? Cumulative undiscounted cash flows, cumulative discounted cash flows, payback period, discounted payback period, please let me know.
Payback period, how you calculate it? 830 divided by?
Discounted payback period and payback period are calculated same way. It's just that the values what you take.
See, Weber, first thing, what is your cash outflow? 1000? Year 2 cumulative is 830. Year 3 is 1440. So it has to be between year 2 and 3. So first thing you write down is 2 plus. Alright. Now, the difference between the end point and this is 170. Divided by the cash flow that occurs at year 3 is 610. This will be 0.26. Similar way, calculate this, you should get 2.68.
2.48. What's the denominator in the second one? 434. 434.
Denominator is 434. So the only confusion while discounted payback, a lot of people lose marks is the denominator, they might take it as 610 instead of 434. And as you all can see, not just in this case, but in any example, payback period will always be greater than discounted payback period. Simply because the cash flow is
Other way around.
Yeah. It's simply because the cash flows not discounted will always be greater than discounted cash flows.
Whoever did not understand, please raise your hand.
Mike?
Or at least wake up.
Will be the discounted values and will not be these absolute present values at whatever year, right?
Sorry?
I'm saying when you are calculating with discounted cash flows.
Yeah, I'll just run this step by step. First thing that you do is calculate the present value of each of the cash flows.
Okay.
393, 311, 434 and 254. Then you add up these. The second it goes from one period to the next where it crosses the cash flow, it will be between those two periods. And how much of a fraction it is? The T minus 1 period, 2, plus the difference of amount to be realized to 1000 divided by the cash flow, the discounted cash flow occurring at that period.
So what you did.
So for discounted payback period, it will be 2 plus 296 divided by 434. All of you all got this answer? Any doubts? So there are 4 ways to evaluate a project: IRR, NPV, payback, and discounted payback period. Know that IRR can have multiple IRRs in case it has a non-conventional cash flow. Vinayak, what do you mean by non-conventional cash flow?
There will be a negative, so there will be positive cash flows and then there will be a negative also.
Then positive.
Then positive, then there will be a negative.
That is a non-conventional. In that case, you will get a multiple IRR. So rely on the NPV criteria. The other problem with NPV is that it gives you a relative percentage measure.
There is also one more, right? Profitability actually. No.
That is not disclosed.
Mike, your conventional cash flow, that only your cash flow at period 0 is
negative. All others are positive.
Just the 0 period.
Yeah, there's only one sign.
But one sign change can also be like cash flow at 1 can be also negative. Your sign change technically is just 1.
Yeah.
So
negative to
CF1 and CF2 are also negative. And then from CF3 it turns positive.
That's a conventional cash flow.
That's a conventional.
So a tidbit on IRR. Hello, everyone. So there is a small tidbit on IRR. We talked about this non-convention cash flow thing, right? So in general, how many IRRs do we have? 1, right? In general, where you have outflow in the beginning and inflows at later, you have 1 IRR. You can always know how many IRRs are going to be there looking at number of sign changes. So in conventional case, we have outflow in the beginning and all inflows. How many sign changes of cash flows? 1. So there will be 1 IRR. If you had a negative in the end again, you will have 2 IRR. If there was another positive after that negative, 3 IRRs. So you can calculate how many IRRs are going to be there.
Guys, how many sign changes are there in this? This and this one? So how many IRRs will this have?
3.
No,
there are 3 sign changes. So you get 3 IRRs.
It's just to know, you don't have to calculate as such.
Okay, and adding to Vinayak's point, is this a conventional cash flow or not?
The middle one.
Conventional.
Yes? Yeah, it's not. Anyone else disagrees? As long as there's only 1 sign change, and you have initial stream of outflows followed by inflows, which is typical of most projects. Like Suzuki, we invest in a new plant that might take many months or years to build. So each quarter or each year there is an outflow followed by sustained period of inflows. So you have negative first 3 years and then followed by positive. So that is a conventional item. So just remember, like Saurav said, the number of IRRs is equal to the number of sign changes of the cash flows. Then profitability index. So the profitability index is also a 5th and last measure of how viable a project is. Basically, it's PV of inflows by PV of outflows. If it's greater than 1, accept the project. If it is less than or equal to 1, reject the project. This is a really simple concept and another measure.
So you already calculated this. Right? PV of inflow, PV of outflow. It's just a ratio of both. And you can also
There are just different ways of measuring a project's viability and how good a project is. Just different measures. Each of them have their own positives and negatives.
So, what is the formula for NPV? PV of inflow minus PV of outflow, right? So, this formula is driven nothing but from this. PV of inflow and PV of outflow is NPV. If you want to replace this, you can also say NPV plus PV of outflow is also Does this make sense? So you calculate NPV. If you've been given NPV and you've been given PV of outflow, you can still calculate the profitability index this way, because NPV is nothing but present value of inflow minus present value of outflow. Got this profitability index? So if profitability index is more than 1, what does that mean?
You accept the project. So these are the 5 measures to evaluate any project. Expansion project, replacement project, regulator enforced project, pet project of the CEO. It can be any new project. In order to evaluate it, you all can use any of these measures or a combination of these measures. This is a really important concept in finance, and even those who are not majoring in finance, if you all want to look at the effect of the expansion and what it will do to a firm's value, then you look at these 5 measures. Anyone has any doubt? I'll move on to the next 2 concepts. Done. Okay. So I'm moving on to the cost of capital.
One more thing.
Yeah.
Touch upon like what do you actually consider in the cash flows, what you don't, like type of costs.
Yeah. Okay. Guys, one last point. You have your cash flows. Okay, guys. Is tax deducted from these cash flows or is it included in this cash flow? It's an after-tax cash flow measure. What about interest and financing costs? So do you include it after this? What do you guys do? The interest and finance charges are implicitly taken within the discounting rate. Let's not get into depreciation. I'm just looking at the cash flows. After-tax cash flows. All right. Whenever you're evaluating a project, it is not based on accounting income. It is based on cash flow. That's the reason why we add back depreciation, because it's a cash flow measure, not an accounting income measure. Second is it is an after-tax effect. Third is interest and finance charges are taken care by the discounting factor. Fourth is some costs are not considered. Some costs could be evaluating, market surveys, market research. And those of you who follow football, Man United paid Jose Mourinho about 5 million in December not to sign to anyone. Now, whether they sign him or don't sign him, that is irrelevant to measuring that capital project, because that is a sunk cost. Basically, any cost which, whether the project is taken or not taken, it is an outflow. So those are not considered. So please be careful of these things. After tax measure, no interest and finance charges as is reflected into the discount rate, and some costs are ignored. All right. And second thing is we need to take care of externalities. How this project might cannibalize another division in the company, or in mutually exclusive projects, if you take project A, then you cannot take project B. Then you have to see which project with a higher NPV you have to get. Okay. So moving on to the cost of capital. You look at any company balance sheet, you have assets on one side, which the companies invest in, current assets and non-current assets, and you have equities and liabilities. Assets are what the company invests in, whether it is over this year or over multiple periods, in order to generate cash, increase shareholder value. And equities and liabilities are the source of cash. Now, the source of cash can be from debt or equity. All right, those are the only two sources of cash. For the time being, let's take that. All right, so our total cost for the ISB program is about 30 lakhs. So in case the bank financed the entire thing, then we would have a 100% debt structure. If some people are well off and they finance it on their own, it would be a 100% equity structure. If not, if they take say a 10 lakh loan, then it is split between equity and debt. So these are the two sources of cash for a company. Now, we need to find the cost of capital, that is the cost of equity, let me denote it as RE, and the cost of debt. So the capital asset pricing model, we have the cost of debt as the risk-free rate plus beta times the market premium. Notice sometimes you might be given the return on the market and asked to compute the return on equity or the required return on equity. You need to subtract the market rate from the risk-free rate. What we mean by the market premium is that if the market earns 14% and your risk-free rate, say in the US is say 3% on fixed deposit or US Treasury notes, which is considered the safest possible financial instrument, then your market premium is 10%. What we understand by beta is if we plot the return of the market against the return of the individual security. All right. What do we get? That is, for 1% change in the market, how does the return of that specific security change? Does it go up? Does it go down? Does it remain the same? All right. Now, when we say beta of debt is equal to 0, all right, most of y'all have a fixed deposit account. Suppose the market goes down by 12%. Will your return on the fixed deposit change? No, right? Market goes up by 100%, it doubles overnight. Will the return on fixed deposit change? No. So that is what we mean by zero sensitivity. When we say beta of debt is equal to 0. Now, when beta is negative, when the markets go down, the return on your asset goes up. Sorry? Yeah, gold is a primary example where suppose, say after Brexit or a war or the 2008 financial crisis 2012, there was a large-scale exodus of capital and people were looking at the reserve currencies of the world, the dollar, yen, euro, and gold. So these are assets with a negative beta. If the market goes up, they go down. And generally, if the market goes down, these go up. That's what is meant by beta is negative. And most of the stocks have a beta between 0 and 1. All right?
Market goes down or market goes up.
You measure the market by an index. You have the BSE 500, you have the CNX 50, you have the Dow Jones Industrial Average. Yeah, all of them. So basically, in order to judge whether market goes up or down, we look at what could be a proxy for that. So we might take 500 stocks with the biggest capitalization. You might take ICICI Bank, Hero MotoCorp, Reliance Industries, Tata. So these, say 50 stocks or 500 stocks, so you have the Wilshire 5000 index in the US, will represent the market with a 99+% accuracy. So if I say the Sensex is at say 7,000, CNX Nifty is at 7,200 points. What I mean by going up or down is this goes to 7,300 or this goes to 6,900 when you read about it in Mint or Economic Times or something. And so when the market goes up, does your stock go up or go down? So highly cyclical stocks, right? Like the auto industry and others, if the market generally goes down, people will defer sales or not buy them. So the auto stocks will generally go down. So the auto sector is generally has a very high beta. While something such as commodities like toothpaste, soap, and all that, regardless of the market going up or down, you will not, stop spending, or it will be minimal reduction in spending. So their beta might be 0.2, 0.3. It's very important to understand. Or say tobacco companies, say if ITC minus the hotel part, people will spend on cigarettes regardless of the state of the economy. So their beta will be very close to 0, not 1. All right. And say defensive industry, say Mahindra or Reliance get into defense procurement, they're going to spend regardless of whether the market is going up or down. So this is what beta measures, and the formula for beta, it is not equal to the slope. Beta is equal to covariance of the security with the market divided by the variance of the market. Let's not get into this formula right now. Just know that it's not equal to the slope. All right. So we get this beta and the risk premium of the market and get the cost of equity, and then we get the cost of debt. Now in a company structure, suppose you have 60% equity, 40% debt. That is, you have $600 million in equity and $400 million which is borrowed from the bank, right? Your weight of debt is 0.4 and weight of equity is 0.6. Now, what we mean by weighted average cost of capital is that we take in the cost of equity, we take in the cost of debt and multiply it by the assigned weights. Suppose ISB had, most of us have got, say, a bank interest rate of 10%, 9.3, 9.4%. Let me take it as 10% for easy this thing, right? Suppose you have 12 lakhs in debt and 18 lakhs in equity. The cost of debt is say 10%. Cost of equity is say 18%. What I mean by cost of equity is where you might have invested in it had you not pumped it into your ISB fees, the opportunity cost. Now, the weight of debt is equal to 12 divided by 12 plus 18. Everyone with me? Mansi? The weight of debt is just the amount of debt divided by the debt plus equity, which will be 0.4. And weight of equity will be 0.6. So we calculate WACC as RE into WE plus RD into WT into the tax shield. Why we multiply this factor of 1 minus T? Because whatever debt you take, if you look at an income statement, interest is deducted before the taxes. So in effect, you do not pay taxes on the interest component. So that is why the minus T into RDWT is known as the tax shield. So this is known as your WACC for any project. And the last concept is free cash flows. Anyone wants to answer what they understand by free cash flows? Okay. Initially, your company has revenue, nothing but your sales, right? Then first thing that you need to do is subtract whatever products that you buy. That will be minus COGS. Right? Then minus SG&A, selling, general and administrative expenses. this minus this will give you a gross profit margin, and then this will give you EBITDA. Right?
Now I get the EBITDA joke. I didn't know what it meant.
Okay, minus depreciation and amortization, you get EBIT, minus interest, EBT, minus tax, and you finally get net income. Alright, this is known as the operating margin of a company, and revenue minus COGS is the gross margin. Now, free cash flow is what cash is available to the debt and equity holders after your COGS, your SG&A, right? And your taxes to the government. Because these are contractual cash flows that have to go out. Then what cash flow is remaining to the people who financed it through equity investment or debt, providing debt capital, that cash flow is known as free cash flow. You have free cash flow to firm and free cash flow to equity. Free cash flow to firm is nothing but the cash flow available to your debt and equity holders. Free cash flow to equity is what is available to your investors. Yeah, I'll get to that.
Can you repeat the
CapEx is also free cash flow is after CapEx.
Yeah, after tax.
After CapEx, capital expense.
So you have net income, free cash flow, all right, plus depreciation since it's a non-cash expense, minus working capital investment. Incidentally, this component is known as your cash flow from operations. You all might have come across this in FADL. Minus fixed capital investment. So you get whatever money after paying all of them, but depreciation is a non-cash expense. It's a notional expense, so you add back depreciation. Then you must need cash for your working capital and to invest in your fixed assets to run the company. So free cash flow is this formula.
I think it's delta WC.
Yeah, change in net working capital, same thing. Whatever the increase in net working capital for that year, that's what I meant. And fixed capital investment. So whenever you all are evaluating a project, initially you will have to have some capex to invest in a new plant and machinery, maybe new automobile manufacturing plant or any new this thing. So you have fixed capital investment. Then you will require some working capital to have the show running. So that is your working capital investment. Then you have cash flows. Say it's a 5-year project. At the end of the 5 years, whatever working capital that you all had invested at the start, the change in working capital, delta, will be got back. And you will have a salvage value for the asset. You buy, say, a machine for $7 million. It's depreciated on a straight line basis for, say, 10 years. Then you have book value, which will be $3.5 million. Depreciation is 10% per annum over 10 years, right? So at the end of 5 years, my machine in the book of accounts will be worth $3.5 million. And say I sell it for $5 million, that is the market value. So I will get $5 million, the salvage value, minus the tax on the capital gain of the machine. That is the difference between what I sell it in the market and what I have it in my books of accounts. So if the tax rate is 30%, then I will get 5 million minus 30% of 5 million minus 3.5 million. Because what you actually sell it for and what the value is stated in your book of accounts usually almost always is different. Because what you sell it is based on market conditions and what is there in your book value is based on depreciation. Now each of these cash flows will be change in sale. Alright, let me remove the delta for the time being, it's understood. What I mean is incremental sales. Minus your costs, that is your COGS and your SGA, minus depreciation. You all will have to pay a tax on that. So minus this minus tax of that part, I just factorized it and get it in brackets is 1 minus T plus depreciation. This is the master equation for any capital budgeting. If you all understand this slide, all you need to do is draw it in a timeline, fix the values, and you all can solve any problem given in the exam. That much I can assure you. You just need to understand this thoroughly. Initially fixed capital and working capital investment, followed by a stream of cash flows. In the end, you get working capital back and your salvage value minus the tax on the capital gain part. All of these cash flows. So this will be your cumulative negative cash flow for year 0. Then all of this, year 5, you will have to add these 3 cash flows. Take the present value of all these cash flows and you will get the NPV of the project given a cost of capital. And if you want to find the IRR, take all these cash flows, which the cost of capital makes the NPV equal to 0, will give you your IRR. That's all there is to capital budgeting. You have a few variants such as replacement projects versus expansion projects, but that's not in the syllabus. So this should hold you in good stead. So I'm done with all the concepts. I thought I'd solve a few problems from the notes for maybe another 10-15 minutes. Up to you guys.
Can you explain that EAS part? Last day, professor was explaining EAS.
The equated annual annuity approach.
No. Equivalent annual series.
Yeah. As soon as say the P2P is over, shall I tell you right? Equated annuity approach. Basically, what the concept I'll tell you. What Rahina is asking. Suppose I have all right. Suppose I have one project which is for 4 years and this is the cash flow stream. Let's take this as minus 100. And another project with this cash flow stream. It's unfair to compare the NPV of these two projects because usually almost always the project with a greater life will have a greater NPV. So what we do is find the equated annuity approach. We find the present and future values and then find the PMT, the payment function that equates the present value to future value. It's similar to finding the EMI of a bank loan. Alright? You find the PMT for this and you find the PMT for this. And then it is a fair comparison between the two projects. Equivalently, you can roll over this. So say 3 and 4, you repeat the project as minus 20, 20 and 20. So the cumulative cash flows will be minus 20, 20, 10, 20 and 20. Now these two projects are comparable. That's all there is to.
Okay, we can do this way.
Either approach. This is called least common multiple approach and this is called equated annuity approach.
How you calculate this is once you have got the NPV, right? Take down the NPV, take down the number of years into that project, take down the
Guys, you will have your lab. Sorry, go on. You'll have your laptops with you, na? Any specific problem you'll want to solve? Let's start with that.
This one, which is given handout, will be beneficial for all.
Okay.
Equivalent annual series in the handout piece. When you have to project JLK, what are they? What if you can just run?
Yeah.
So for this one, as I was saying, once you have the NPV, once you have the NPV, you have interest rate, you have number of periods, years. Enter those all things into your formula and compute the payment. What that means is that if you have to get that NPV equally distributed over the life of that project, how much is that amount? That is your concept of EMI, right? So once you get that EMI or the payment, that means that on this project, I can earn X amount over the next 5 years. And on this project, I can earn Y amount over some other year. So that becomes comparable.
So what I'll do is, Rajan, straight after the P2P, I'll solve this for you. So guys, let's just solve one really chunky capital budgeting problem and then we can close for the day. Yeah.
Yeah, I didn't understand the PMP. What is PMP?
PMP is basically the payment. Na? Suppose you're given a amortization where you have to pay back 30 lakhs in say 20 years time at 12%. What is your EMI?
It's the EMI.
Yeah, it's the payment plan. Okay guys, this is the capital budgeting problem. I suggest that let's solve this one piece of problem and then I think any problem on the exam would be quite easy. Alright. Calculators, everyone. Shall we start this last problem for the day?
Go for it.
Okay. You're given the responsibility of conducting the project selection analysis in your firm. You have to calculate the NPV of a given project. Approximate cost of capital is 12% and the firm is in 30% taxes. So my suggestion is, as you all read the question, jot down what is the data given. So from this, I get R is equal to 12% and tax is 30%. Everyone with me to that? Then the project is going to be built on a piece of land that the firm already owns, alright? The market value of the land is 1 million. The land can be sold at the end of year 10 for 1 million. So what I get from this is that initial capex outflow of 1 million, salvage value at year 10 will be 1 million.
Could you repeat that?
I get initial capex from the land investment component is 1 million. Salvage value at year 10 is 1 million. If the project is undertaken prior to construction, an amount of 100,000 would have to be spent to make the land usable. So that the second point also comes under capex to make the land viable for construction. In order to come up with the project, the company hired a market research. All right. So this $200,000, do we include it? Not include it? Why so? Anyone, Satya? Yeah. Not included. Okay. Point number 4, Ashish. Should we include? Not include? Not included. So you include the 1 million for the land and 100,000 for the preparation of the land. All of you all are noting this down?
Yes. But all these costs are ultimately going towards the project.
No, but a sunk cost is whether you take the project or you don't take the project. This is done in Dustin.
This won't be my capex.
You only evaluate something.
Even
Even you have to take a decision on whether you want to expense on it.
already,
If you have already expensed on it, then you don't need to take a
So already
decision.
that project we have already got the land as well. Whether we do the project or not.
So that's an opportunity. Market value of the land is given as well.
The land can be put to another use. Market research cannot. Alright. So anything where whether you take the project or you don't take the project, that cost is, foregone is a sunk cost. Alright. So everyone with me, the last 3 and 4 points are sunk cost. Point 1 and point 2 goes into fixed capital investment. Now, point number 5, the project will require an initial outlay of 20 million that will also go into your capex. So, you guys remember the timeline that I had made, right? Initially, for cash flow 0, fixed capital, working capital will be your investment. So, under fixed capital, we have 1 million for land, 100,000 to prepare the site, and 20 million for plant and machinery. So I have 21.1 million in capex thus far. Point number 6, the sales from the project will be 15 million per year, of which 20% will be lost from sales of existing products. Remember my point about cash flows, you have to take into account after tax effect, financing effect, and externalities. So this is a cannibalization effect. So what will be my net incremental cash flow, Parika? Point number 6. Yeah. 80%. So it will be sit. This is very important concept. Sit for 10 more minutes. This is really important. So you get 12 million as your incremental sales. Remember my timeline in which the cash flows is S minus C minus D into 1 minus T plus D, right? Coming to point number 7, the variable cost will be 9 million. So that is your C. Then the project uses straight line depreciation, economic life of 10 years, and will have a salvage value of 3 million at the end. So basically what it means is that to find the depreciation, you have an initial value minus your salvage value divided by the number of years to get your depreciation. So this is point number 8, is to calculate your depreciation expense. So Vaibhav, what is the depreciation expense per year?
For 10 years it is
25 million.
Salary. 3 million.
No, land never has a salvage value. Land is never taken as depreciating assets.
But initially, for the land, we said we're taking as sell it out
1 million. You buy it for 1 million and you sell it for 1 million.
17 lakh.
1.7 million.
Yeah. Just keep that with y'all. Then let me come to the point 9.
Mike, can you write the point number 8 for depreciation?
Point number 8 can you run?
1.7. So minus.
It will be 20 million minus 3 million by 10 years. Initial value minus salvage value divided by number of years will give you a straight line depreciation. Right?
This is only for the machine based thing.
Yeah, land you don't depreciate, na? So honey, are you with me? Okay. Then moving on to point number 9. The project will need additional working capital of 1 million. This is where Keshav's point delta. So the additional working capital is 1 million. Enter it in your WC investment. Just plug and play in the formula which I have given and it will become very easy. The project will require additional supervisory and managerial manpower that will cost 200,000 per year. That will be part of your costs. And accounting department has allocated 350,000. There are no CAs in the room. Okay. So that you all don't consider it. Alright. So that is not considered because that is an internal division of the cost.
So you're saying SGA we don't consider?
No, we don't consider that as a cost. 350,000 allocated for supervisory and managerial. This is basically an internal classification of accounts, not actually what is happening. The most important point in capital budgeting is that we are based on cash flows, not accounting income. Sorry.
So all allocated, whatever information is given, we ignore.
Yeah, which applies to net income but not cash flow. All right. So as we got 22.1 million, I must have missed out 1 million somewhere.
That's working capital.
Okay, sorry. So your fixed capital investment plus working capital investment is 21.1 plus 1 million in working capital, which gives you 22.1 million. This will be CF0. CF1, CF2, CF3, just apply S minus C minus D into 1 minus T plus depreciation, since we are looking only at cash flows. This is the depreciation that we calculated. Initial value minus salvage value divided by the number of years. Incremental sales, because 20% is lost on cannibalization. And this is a measure of, what is the cash flow. So you have S, and these two will be C minus D. And then you subtract the 1 minus T component and then add back depreciation. This will be your cash flow for each of the years. So remember that initially you have a fixed capital and working capital outflow, then you have a stream of cash flows. In the final year, you will have the same stream of cash flows, but working capital investment you'll get back plus salvage value minus tax on the capital gains of your machine.
Hi, can you please go back?
Just go back. Just go back.
This one? Yeah.
So Mike, you have to put all these values in that master equation which you told us, right?
Yeah.
So what you have to calculate here is CF1.
Calculate CF0, CF1, CF2 at a very high level. All you need to do is construct a timeline, assign cash flows to that timeline, and pull it to the present value. That's all you need to do in any problem.
So by this master equation, we are calculating cash flows at each period.
At each period, discounting it back to present value, and then calculating your NPV of the project.
Okay, so here, first one is sales, right?
Yeah.
12 million. Then the second and third are cost.
Yeah.
Fourth one is depreciation.
Yeah.
And what about the fifth one? With this tax.
This is your tax. Basically, what I wrote, S minus C minus D into 1 minus T, can be written as S minus C minus D into minus tax of S minus C minus D. Right? You have revenues, you have cost, and you have a operating margin. You have to pay tax on that. Na? So that is what I'm subtracting. This you just factorize it, you'll get 1 minus C. Shall I move on now? Okay.
Just one point. If the salaries were not allocated and there was a thinking on it, then how we would have treated that?
You ignore it. All capital budgeting is based on cash flows. Any accounting income notional treatment is ignored. That is why we are adding back depreciation. Cash is king in a capital budgeting problem.
Like what are the point number 5, 6, and 7 according to this equation? 1.1 million and
which one? This is 0.5, which goes into capex. This is 12 million, that is 0.8 into 5 million, that goes into sales.
Sorry, in the table, the fifth row, supplemental tax. 1.1 million. Yeah.
So this is your sales. All these are your costs, right? Your costs are 11.9 million. So you get pre-tax income as 1.1 million. Tax is 30% on the pre-tax income, na?
Why did we add back the depreciation? I'm sorry for not.
Because we always look only at cash flow. Depreciation is a notional expense. Why we have depreciation in companies is if you buy a machine for 10 million for 10 years, actually there's no outflow, but suddenly at year 11 you will have to again reinvest in the machine, right?
Then I've considered it. So then why have I less incremental depreciation? Why did I do that? I could have ignored it there itself, right?
No, so that is what we are using the formula of net income and then going to cash flow of operations. There are different ways of arriving at free cash flow. One could be directly from cash flows. One, I'm using net income and then converting it to a free cash flow. So final year, year 10, you will get your cash flow as normal. Then you will get back your working capital investment of 1 million. And you will get back your salvage value minus tax on the salvage value, which will come to 7.47 million. Anyone has any doubts in that?
Doubt. The last one.
Can you go back to the
Last
previous
one
slide?
could go back.
Wasn't that 3 million? Was 20 minus is, so that was 3 million. There's a 1 million salary for the land also.
1 million increase in
Perfect. It will be 1 plus 1 plus 3. Yeah. 1 million salary for land, 1 million working capital, and 3 million salary for your machinery.
Okay, so terminal year cash flows, you'll get back 1 million from the land, 1 million I think from working capital.
Yeah.
All right. Now machine initial cost was 25 million.
Yeah.
And depreciation was 1.7 million. Yeah.
20 million.
20 million.
This was 20 million, not 25.
20 million. Okay. So depreciation, accumulated depreciation is 17 million. So book value at the end of year 10 will be 3 million. And how much does he sell it for?
3 million.
He sells it for 3 million. So according to me, you should add back 3 million.
Yes, right. 5 million
to your cash flows. And minus 0.33 into 3 minus 3. Or whatever the tax rate is. So that's it, guys. Thank you.
Can you take on the role of our professor whose name I don't know?
Dude, how do you explain if we understand? I don't understand what the professor role is.
I mean, Mondays and Wednesdays, most unproductive day for me.
If you need any help with the calculator, let me
I will. I might just bug you. Yeah.
So guys, any of you need any additional help specifically with the calculator, get in touch with Mudit, Nota or me. Because this is all, yeah. That would be really bad at all. Yeah.
क्या बोल रहे हो?